Hello fellow investors, thank you for joining in Ascending Abundance YouTube channel where I cover strategies on how to make more money with money while saving, and living frugally is one of the greatest strategies to become financially independent. I do prefer the abundance mentality and planning to make more money and spend money and kind of enjoy life, and therefore explore all the strategies that can help me get there. Would be that real estate, stock market, crypto, or any other ways, business that could make people more money and get us rich. One strategy I want to cover today is the one I'm using in the last few weeks and planning to continue using while it makes sense, is put options on some of the ETFs that I find have decreased in price due to the volatility in the last year. The one particular up on the screen here is iShares Semiconductor ETF, symbol SOXX. You can see it contains NVIDIA, it holds Texas Instruments, AMD, Intel, and a lot of other companies. They're pretty good. If one of them screws up, the competition kind of creeps up on them, while the overall ETF is going to be way more stable than the individual company. And at the same time, if we look at the chart of SOXX, it went all the way up to 550 and then all the way down to 300. Yet long-term trend I find is continuing. It's just going to continue growing. The demand for semiconductors is huge. There's AI, there's Internet of Things, there is crypto, there's plenty of usage for the semiconductors in this world. It is going to continue to be a profitable business to be in. So if I have to buy this, if I'm wrong with my assumptions, but I'll show you shortly, I'm still going to be holding a fairly good asset that I'm comfortable that is likely to continue going up. So the calculations, let's just focus on this section right here. SOXX went up to 500, went down to roughly 300. It's a drop of 40%. Tells me that the risk has already been kind of taken out. The excesses have already been flashed over. Even if it drops, it's not going to drop dramatically. That's my assumption. You can believe it, you can use it, or you can make your own. So I'm comfortable saying that if today's price was about 405, which I've built a few weeks ago, that was the price was. If you just take a 5% discount, that gives us a strike price of about 385. 1 month out, April, so I was in the end of March, so April 21st put option was worth $5.05, and that's a rate of return of 1.3% if you look at the price of the put divided by the strike. And if we do this 12 months out of the year, that's a 15.7% rate of return, fairly decent for the exposure that I'm thinking. So as a reminder, one put is 100 shares, so you're getting about 500 bucks. $505 technically, but there's transaction costs, there is probably bid-ask spread, so you're gonna have to kind of round it down. And then again, one put is 100 shares at the strike price of $385. That's gonna give you a total exposure of 38,500 bucks US that you're risking in order to make these returns. To me, that sounds reasonable. The second ETF that I'd like to share with you is called KWEB. That is a Chinese e-commerce, overall internet kind of exposed companies. It holds Tencent, Alibaba, there is Baidu, there is JD.com, so lots of companies that are providing you technology Chinese exposure, which I also believe is fairly safe. And the reason I believe it's fairly safe is because it went all the way up to $95, the KWEB, then it crashed all the way down to less than 20. With that type of a downturn, we're trading, even today that it jumped back up from the 20s to the 30s, we're still trading below the levels that it was 5, 6, even 7 years ago. So you're picking up these companies at the bargain, considering that the amount of cash and liquidity in the system went up, inflation's up. Just purely from that perspective, we should be well higher than the 6-year-ago figures. So this is, in my view, fairly safe still, and continues to be fairly safe. In fact, all the way until it reaches about 40, I would believe that, at these levels, see the support and see the kind of the peaks here. I think until that level is reached, we are super safe. So looking at KWEB, I went with the same approach. It went to maximum 90, went down to about 30. It's almost 70% discount. It's fairly safe. If today's price was 31.50, which it was at the end of March, and I look at the strike of about 5% below that, so that's roughly 30 bucks, every 2 weeks, so I'm looking at weekly options now. KWEB is very volatile. Their options are expensive. I don't even need to wait a month. For the 2 week out option, I would get 49 cents. That's a rate of return of 1.6%. Those are actual trades I've made, both of them. And the annualized is about 40%. So because the strike price is 30, not 300, just 30, I would look to use 10 puts instead of 1 put. So 10 puts, 1,000 shares exposure, gives me about $490. That's 49 cents times 1,000 shares, $490. But because I do this every 2 weeks, not every month, every 2 weeks, so I can do it twice a month. So technically within a month, if the price stays the same and the pricing of the puts are also staying the same, then we're going to get almost $1,000 by risking 1,000 shares times 30 bucks by risking $30,000 exposure. Really good trade in my view. I use both of them. I've done this a couple of times already, and if it dips below 30, which it could totally, you can just start selling call options. In fact, you can sell call options not on 30. The last time I've done a call option on 30.5, and when the price went the other way, I was happy to get called and sell it at $30.50 and make that $500 extra on the price swing as well as on the call option. So all in all, using these two strategies, if you look at summing them up, so just the summation, gives you almost $1,500 a month of premiums. Total exposure is under 70,000 US. The return is just over 2% a month. If you annualize it, we're getting 25% a year. Now that's considering everything stays the same. If we can repeat it multiple times, hopefully, but nevertheless, that's an opportunity. And then what else I looked at is what happens if we 10x it. So if you 10x your exposure, you can get $15,000 a month, and those are US dollars. I'm in Canada, so this is a good chunk of change. To be honest, I could probably buy somebody financial freedom. If you have $15,000 coming in every month just by doing this trade, then you probably don't need to even go to work, depending on your circumstances. Exposure though would need to be just under 700,000 US dollars. That's quite a lot of money to be exposed to 2 ETFs though. So those are ETFs, those are buckets of securities. Still fairly risky. However, if you can stomach that risk, if you have that much money, you don't even need 685,000 in cash. You could say that through the Interactive Broker, as many other brokers, you can use leverage. You really just need a third of the money, so about 200,000, just over 200,000, to support the exposure of 685,000, which will allow you to generate almost $15,000 a month in cash flow. Now, this may be an extreme for some, or it could be actually conservative for others. It depends on your risk level and risk tolerance. You can use this strategy, you can 10x it, you can half it, you can do 1 put here, you can completely disregard one of them and just use one or the other. It's completely up to you. You can kind of tune your leverage by the exposure. So if you're comfortable with 70,000, that could be it. If you want to half that, that could be it. If you want to 5x, 10x it, it could be that. So whatever you're comfortable with, just know that you could generate about 25% rates of return. I am using both of these strategies these days. While KWEB is staying under roughly 40 bucks, and while SOXX is staying close to about 400-ish, give or take, I'm going to continue selling these puts. And if I get put, I'll just hold it and start immediately selling calls in anticipation for the market to swing back up and for me to actually make money, not just on the option premium, but also on the strike price that I could use slightly higher than the price that I got put. So thank you for watching. This is just one strategy of many. I'm hoping this is adding value to you and gives you some thought. If you have any comments, if you would like to like this video, just hit the like button, subscribe to the channel. It'll help me tremendously to push it forward and provide you with more ideas, which I kind of float up every other day and try on my own on how to make money when you already have money. Thank you so much for watching, and connect with you later. Thanks so much.